Today's pick number one is X. Let's dive into the recent buzz around United States Steel Corporation, which has seen its shares take a significant dive, sparking talks that it might be oversold. This stir comes amidst President Joe Biden's firm opposition to Nippon Steel's planned acquisition of US Steel, a move that's not just about business, but is tinged with national pride and economic sovereignty. Imagine US Steel as the backbone of America's industrial might, a company steeped in history and significance. Now there's talk of it being acquired by a foreign giant, Nippon Steel. Picture the White House stepping in, with President Biden emphasizing the critical importance of keeping strong American steel companies powered by American steel workers. This statement wasn't just a nod to the economic implications, but a clear stance on maintaining the national fabric. The response was immediate. US Steel shares tumbled more than 10%, a market reaction that underscores the weight of presidential words and the intricate dance between national security, economic interests, and the global stage of trade and investments. The deal, under the scrutiny of the Committee on Foreign Investment in the United States, now appears on shaky ground, facing political headwinds that could stall or scuttle the acquisition. This scenario isn't just a business transaction, it's a narrative rich with themes of American identity, job security, and the strategic importance of domestic industries. It's a reminder that in the world of stocks and trades, the currents of national interest and political influence can sway markets, sometimes unpredictably. US Steel's story is not just about a potential deal falling through, but about the assertion of national priorities over global commerce, about the resilience of American industry, and about the balance of power in a world where business and politics intertwine. So, as you think about whether US Steel is now a bargain, remember the layers of complexity that surround this ticker. It's a tale of how global ambitions can clash with national interests, and a reminder that in the stock market, as in life, the undercurrents of history, culture, and politics play a role in shaping outcomes. Today's pick number two is TBBK. The Bancorp Bank is a Delaware chartered, federally insured commercial bank which focuses on service to small and mid sized businesses and their principals in the Philadelphia Wilmington market area, and on private label affinity group programs, including merchant card servicing. The Bancorp Bank operates within the bank's Northeast industry, which is ranked 178th out of 252 industries by Zacks Investment Research. All right, let's talk about how the Bancorp Inc. been doing lately. Imagine you're keeping track of this company like it's the score of your favorite sports team. In the last part of 2023, they scored a net income of $44.03 million just in one quarter, and for the whole year, they made a cool $192.3 million. That's like winning a championship in the banking world. Now, they're so confident about next year, they've told everyone to expect their earnings per share, or EPS, to hit $425. And on top of that, they're planning to buy back $200 million of their own shares. It's kind of like a team saying they're not just going to win next season, but also planning a victory parade. With a solid game plan, the Bancorp has been upping its game in areas like net interest income, which is the money they make from loans and other investments, reaching $92.16 million in just the last 3 months of 2023. They're really showing their strength, especially in the prepaid card league, pulling in more money from fees and services. Their financial health is pretty strong too, with total assets of $7.71 billion by the end of 2023. It's like having a star-studded team with a solid bench ready to take on whatever the market throws at them. So, if you're hearing rumors that the Bancorp stock is oversold, think about all these achievements. It seems more like the market's mood swings might be overlooking how well this team is actually playing. For those just getting into the stock market, it's a good lesson. Look beyond the daily scores and headlines. Dive into the team's performance, their strategy, and how they're planning to win in the long run. That's how you spot a potential champion in the making. Today's pick number three is EYPT. iPoint Pharmaceuticals Inc. stands at the intersection of biotechnology and healthcare, focusing on innovative treatments for eye diseases and other chronic conditions. According to Zacks Investment Research, this sector is currently ranked 71st out of 252, highlighting the competitive yet promising landscape iPoint operates in. The narrative around iPoint Pharmaceuticals suggests it might be undervalued or oversold. This perception is fueled by several recent developments. Notably, their fourth quarter earnings for 2023 revealed a GAAP EPS earnings per share of negative 33 cents, which actually beat market expectations by 16 cents. Additionally, their revenue hit $14 million, surpassing forecasts by $5.3 million. This outperformance suggests a stronger financial health than what the market might have anticipated. Further amplifying this view are the positive outcomes from their Phase 2 DAVIO 2 trial concerning EYP 1901, a potential new treatment for diseases of the retina caused by vascular endothelial growth factor. These promising results could imply that the market hasn't fully recognized iPoint's potential, hinting at an undervaluation. Market analysts collectively maintain a buy rating on EYPT, with price targets oscillating between $22 and $44 and an average at $33.86. This suggests a bullish outlook compared to its current market price, despite recent adjustments in revenue forecasts by analysts, cutting this year's expectations by 22%. These lower revenue projections might have contributed to the current bearish sentiment, yet juxtaposing this with their fourth quarter performance and encouraging clinical trial results paints a picture of potential rebound or correction. To sum up, the view of iPoint Pharmaceuticals as oversold may be rooted in immediate market reactions to revised revenue estimates, overshadowing the positive clinical trial outcomes and earnings achievements. As the market recalibrates with a longer term perspective, iPoint presents an intriguing case for investors willing to look beyond the surface. Today's pick number 4 is BOIL. This ETF provides 2x daily leveraged exposure to natural gas. The ProShares Ultra Bloomberg Natural Gas ETF is considered oversold due to a combination of factors, including increased production in the US, particularly from the Permian Basin, which has led to a supply glut. Mild weather patterns have dampened demand for natural gas for heating, exacerbating the oversupply issue. Additionally, market sentiment remains bearish, with futures trading in contango, indicating that traders expect current low prices to rise in the future. This bearish outlook is reflected in the price and performance of natural gas-related ETFs like BOIL. Today's pick number 5 is GRPN. Groupon operates a digital marketplace connecting consumers with local merchants by offering deals through its mobile app and website, Groupon.com. Groupon's business spans across three primary sectors: local goods and travel, generating income through service fees and advertising. Groupon is a player in the internet commerce sector, an industry ranked 81st out of 252, according to Zacks Investment Research. Now let's delve into why some believe Groupon stock might be undervalued. Recently, Groupon's shares saw a sharp decline, dropping by 30.71% to 12.59, with a slight decrease after hours. This significant drop suggests a pessimistic outlook from investors or a general negative sentiment towards the stock. However, it's important to highlight that Groupon exceeded its earnings expectations for the fourth quarter of 2023. Despite this, the company's yearly revenue for 2023 fell by 14% compared to the previous year. The essence of Groupon's business is to facilitate deals between consumers and merchants. The recent financial outcomes reveal a company that outperformed earnings forecasts but is struggling with revenue growth. On the upside, Groupon's focus on reducing costs has borne fruit, leading to profitability in the last quarter, hinting at a possible turnaround. Investor opinions on Groupon are varied, as shown by the significant trading in put options, which could signify protection against further stock price drops or doubts about the company's future growth. Additionally, Seeking Alpha's analysis brought attention to Groupon completing an $80 million rights offering and anticipated the fourth quarter's revenue to meet or exceed the upper end of their forecast, indicating some optimistic signs. In summary, the view that Groupon might be oversold stems from various factors. the recent steep decline in its stock price, mixed financial results, strategic moves towards profitability, and mixed investor sentiment. While Groupon faces hurdles, there are also signs of possible recovery, potentially offering an opportunity for investors willing to engage with the stock's uncertain dynamics.